Hello viewers, we will be going over the S&P 500 ETF ticker symbol SPY. In this video, we'll be going over the day-by-day probability model, how we find the models, and where the S&P 500 will head to next coming days. So back to the technical analysis. Today we're down 7 basis points on the 1 hour chart. We are starting to approach to negative MACD, and on the 4-hour chart we start to see a divergence in play as well, and we are resting on the 18 moving average support on the 4-hour chart. If we extend out to the daily chart, we are very near overbought RSI, and we're still healthy on the daily MACD. We see no divergence in play, and we may fall a bit lower to rest on the 9-day moving average, this blue line. So that is one of our immediate support, but I do see the next real support being the 18-day moving average. And as the day progresses, the 18-day moving average will average a little higher and create a support level around the price of $331.70. So around this range. We also have price concentration around that range as well, past resistance back in January 21st, and in February 7th that acted as support. And since we're above price resistance, that now act as our immediate support. And as for resistance, the all-time highs made back yesterday of $338.12, that is our immediate resistance for the moment. If we were to head up higher, that price movement is roughly around 52 basis points to the upside, and to the downside it is around 1.5% to downside to hit back to support levels. So back to the day-by-day probability model, or day-by-day probability model, yeah. So as the day progresses, we see a slight favor to the upside once again. We have a 58% chance of the S&P 500 climbing between 0 to 2%. On the extreme case, we have around 11% of the S&P 500 climbing between 2 to 4%. On to the downside, we have a 26% for the S&P 500 climbing between 0 to negative 2%, and on the extreme case, a 5% chance for the S&P 500 to fall between negative 2% to negative 4%. So let's head to the day-by-day forecast for the S&P 500. Again, this model is now available in the link below, so do check it out. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to December 11th, 2012 to March 11th, 2013. So let me point out why these two charts are similar. So what we have on the current trend, we average above the middle Bollinger Band for several days. Next, we proceeded to take a dip below the middle Bollinger Band at this instance. Afterwards, we start to average above the middle Bollinger Band once more, and then we take another dip again, and then finally we average again above the middle Bollinger Band. So we have those patterns there. So in the trend in question, we also have a similar instance. We average above the middle Bollinger Band for several days. We take a slight dip below the middle Bollinger Band. Once more, we average again above the middle Bollinger Band. And then for the second time, we take a slight dip below the middle Bollinger Band. And finally, we average again above the middle Bollinger Band lastly. So what we have is 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was December 11th, 2012 to March 11, 2013, back then the S&P 500 was down roughly around 23 basis points. If we head back to the day-by-day probability table or model, it coincides with the standard deviation, 26% chance of the S&P 500 falling between 0 to 2% down. Again, this model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.